Welcome back to the Crypto Shift 2025. If you watched video 1, you know I promised you something different. Well, buckle up, because what I'm about to show you is going to shatter everything you thought you knew about this market. Lean in closer. $4 trillion. That's with a T. The crypto market just crossed $4 trillion in total market cap for the first time in history. But here's what nobody's telling you. That number isn't just a milestone, it's a signal that the entire game has changed. In 2021, crypto was retail FOMO and dog coins. In 2025, it's BlackRock, it's pension funds, it's sovereign wealth funds. And if you're still trading like it's 2021, you're about to get absolutely destroyed. Quick cut. By the end of this video, you're going to understand exactly why institutional money changes everything, how to identify what they're buying before the pumps, and the 3 specific sectors where trillions are about to flow. Let's go. Transition effect. Act 1. The institutional awakening. B-roll, Wall Street, trading floors, institutional buildings. Let me paint a picture of what actually happened in 2025. Show timeline graphic. January 10th, 2024. The SEC approves spot Bitcoin ETFs. Everyone cheers. But most people thought it was just cool news. What they didn't realize is that this opened the floodgates for the biggest wealth transfer in modern history. Show data visualization. Within the first week of 2025, just 7 days, Bitcoin ETFs pulled in $1.9 billion. That's billion with a B. Let that sink in. But wait, it gets crazier. New graphic appears. By August 2025, there are now 76 spot and futures crypto ETFs in the United States alone. 76. And they're managing $156 billion in assets. Pause for emphasis. Do you understand what that means? That means your grandma's retirement fund can now buy Bitcoin. That means pension funds managing trillions can now allocate to crypto. That means sovereign wealth funds from Norway, Singapore, and Abu Dhabi can now enter this market. Show comparison graphic. In 2021, the average crypto investor was a 24-year-old on Reddit with $500. In 2025, the average new crypto investor is a 55-year-old financial advisor managing $50 million. B-roll, financial advisors, offices, professional settings. The game has completely changed. And here's what most people don't get. When institutional money enters a market, it doesn't just make prices go up. It fundamentally changes how the market moves. Show volatility charts. Look at Bitcoin's volatility in 2021 versus 2025. It's dropping. The wild 30% swings, they're getting rarer. Bitcoin is becoming, dare I say it, boring compared to 2017 and 2021. And that's actually bullish, because boring means stable. Stable means more institutions can justify allocating. More allocation means more capital. More capital means higher prices. But it also means something else, something critical that will determine whether you make money. And that's
the 3 phases of institutional adoption, 4:30 to 8:30. Institutional adoption happens in 3 distinct phases, and understanding which phase we're in right now is literally the difference between 10x returns and losing money. Phase 1, the Bitcoin maximalist phase. This is where we are right now in late 2025. Institutions are putting 1 to 3% of their portfolios into Bitcoin, just Bitcoin. Not altcoins, not DeFi, not NFTs, just Bitcoin. BlackRock's IBIT, Fidelity's FBTC, Grayscale's GBTC, these are the big 3, and they're accumulating Bitcoin at a rate we've never seen before. But here's the key insight. When you see those outflow headlines like we saw last week, $903 million in outflows, that's not panic. That's profit taking from early institutional buyers who got in at 30K to 60K and are now rebalancing at 90K plus. But if you track the actual wallet addresses, and yes, this is public data, you'll see that new institutional wallets are accumulating during these dips. Smart money isn't leaving. Smart money is rotating. Phase 2. The Ethereum diversification phase. This is starting right now and will dominate Q1 to Q2 2026. Ethereum ETFs already exist. They launched in July 2024, but they're getting basically no attention compared to Bitcoin. Look at this chart. Bitcoin ETFs, $156 billion. Ethereum ETFs, $11 billion. That's a 14-to-1 ratio, but here's the thing, it won't stay that way. When gold ETFs launched, silver ETFs followed 2 years later. When silver ETFs launched, they pulled 15% of gold's inflows within 18 months. If Ethereum follows a similar pattern, and I believe it will, we're looking at $20 to $25 billion flowing into ETH ETFs by mid-2026. What does that mean for ETH price? Well, $25 billion divided by Ethereum's market cap, I'll let you do that math, but it's very bullish. Phase 3. The altcoin explosion phase. This is late 2026 to 2027. This is when institutions start exploring beyond BTC and ETH. We already have applications filed for Solana ETFs, Cardano ETFs, XRP ETFs, even Dogecoin ETFs. Yes, seriously. I know, Dogecoin ETF sounds insane, but that's exactly my point. When institutions can package anything into an ETF, retail money follows. And when that happens, that's when altcoins explode. But here's the critical part. You don't wait until Phase 3 to position in altcoins. You position in Phase 1 and Phase 2 before the institutional money arrives. Right now, in late 2025, smart money is 40 to 50% Bitcoin, riding the institutional wave, 20 to 30% Ethereum, positioning for Phase 2, 20 to 30% altcoins in narratives that will get ETFs, speculation on Phase 3, 10% stablecoins, dry powder for dips. Point to the screen. This is the allocation strategy that will outperform in 2025 to 2027. Not 100% Bitcoin, not 100% meme coins. Balance. Act 3. The 3 sectors where trillions will flow. Okay, so we know institutions are coming. We know they're bringing trillions. But where specifically is that money going? Based on my research, analyzing institutional reports, tracking wallet movements, studying regulatory filings, I've identified 3 sectors that are about to receive massive capital inflows. Graphics 1 appears. Sector 1, Bitcoin infrastructure. I'm not talking about Bitcoin itself. I'm talking about the infrastructure being built around Bitcoin. Examples, Bitcoin staking protocols like Babylon Protocol, allowing Bitcoin to be staked for the first time ever. Bitcoin Layer 2s like Stacks and Lightning Network, bringing smart contracts to Bitcoin. Bitcoin-backed stablecoins, using BTC as collateral. Market caps. These projects are tiny right now. Babylon Protocol launched in August 2024 with a $250 million market cap. If Bitcoin ETFs are managing $156 billion, don't you think eventually some of that capital will flow into Bitcoin staking yields? Even if just 1% of Bitcoin ETF capital flows into Bitcoin staking infrastructure, that's $1.5 billion into a sector with a combined market cap under $5 billion right now. You do the math on what that means for prices. Graphic 2. Real-world asset tokenization, RWA. This is the big one. This is where Wall Street fully merges with crypto. Real estate deeds on-chain, treasury bonds as tokens, company equity traded 24/7, carbon credits, commodities, art, everything gets tokenized. Industry predictions. Boston Consulting Group predicts tokenized assets will be a $16 trillion market by 2030. That's not crypto degens predicting that. That's traditional finance consultants. RWA projects. Projects like Ondo Finance, Centrifuge, Maple Finance, Goldfinch, these are building the infrastructure for trillions of dollars of real-world assets to come on-chain. And when they do, institutions will have to use these protocols. Example, imagine BlackRock wants to issue a tokenized treasury bond. Where do they do that? On these RWA protocols. And what happens when BlackRock issues $10 billion in tokenized bonds? Those protocol tokens explode in value. Graphic 3. Institutional grade DeFi. Notice I said institutional grade, not degen DeFi, not 50,000% APY farms that rug pull. I'm talking about Aave, Compound, Uniswap, the blue chip DeFi protocols. Look at liquidity numbers. Aave has $20 billion in total value locked. Uniswap processes $2 billion in daily volume. These aren't experiments anymore. These are infrastructure. And here's the key. With clearer regulations coming in 2025 to 2026, institutions will finally be able to use DeFi protocols for yield, liquidity, and trading. When a pension fund can legally lend $100 million on Aave to earn 5% yield in USDC, when a hedge fund can swap $50 million on Uniswap without slippage, when a family office can provide liquidity and earn fees 24/7, that's when trillions flow into DeFi. And the tokens that power these protocols, they capture a percentage of all that activity. More activity, higher token value. Simple as that.
How to position yourself. All right, so we've established that 2025 is not 2021. We've broken down the 3 phases of institutional adoption. We've identified the 3 sectors where trillions will flow. Now the question is, what do you do with this information? Here's my exact positioning strategy for late 2025 into 2026. 1. Maintain a Bitcoin core position. 40 to 50% of your crypto portfolio should be Bitcoin. I know that sounds boring. I know you want 100x on some meme coin, but Bitcoin is where institutional money is flowing right now. Don't fight the trend. 2. Position in Ethereum before phase 2. 20 to 30% allocation. ETH is underperforming Bitcoin right now, which means it's compressed. When institutional money rotates to ETH in Q1, Q2, 2026, it will move fast. 3. Strategic altcoin exposure in the 3 sectors I mentioned. 5 to 10% in Bitcoin infrastructure plays, 5 to 10% in RWA tokens, 5 to 10% in institutional DeFi blue chips. 4. Keep 10% in stablecoins. Always have dry powder. When institutional money causes dips, and it will, remember, those ETF outflows, you want to have cash ready to deploy. And here's the most important part. Institutional markets move slower but more predictably than retail markets. In 2021, you could 10x in a week and lose it all the next week. In 2025, 2026, you'll 2 to 3x over months with more stable trajectories. That might sound less exciting, but I'm not here to make you excited. I'm here to make you money. And the way you make money in institutional markets is identify the trend early, position strategically, be patient, take profits systematically. Boring? Maybe. Profitable? Absolutely. Closing. Look, I get it. This isn't as sexy as buy Elon Pepe, it's going to 1000x. But you know what's sexy? Actually making money. Actually building wealth. Actually being positioned when trillions of dollars flow into this market. Here's what we covered today. The 4 trillion market cap isn't just a number. It's a phase shift. Institutional adoption happens in 3 phases. Bitcoin, Ethereum, then altcoins. 3 sectors will capture most institutional capital: Bitcoin infrastructure, RWA, and institutional DeFi. Your positioning strategy needs to be 40 to 50% BTC, 20 to 30% ETH, 20 to 30% strategic altcoins, 10% stablecoins. In video 3, we're diving deep into those ETF outflows everyone's panicking about. I'm going to show you the on-chain data that proves this isn't a top. It's a rotation. And I'll give you specific price levels where accumulation is happening right now. But before that, I need you to do 3 things. 1, if this video gave you value, smash that like button. It tells YouTube to show this to more people who need it. 2, drop a comment. What percentage of your portfolio is in Bitcoin versus altcoins right now? Let's compare strategies. 3,
Subscribe if you haven't yet, because video 3 drops in 48 hours and you do not want to miss it. Remember, 2025 is not 2021. The sooner you adapt to institutional markets, the sooner you start making real money. I'll see you in video 3. Let's go.